Hello and welcome to Short Briefings on Long-Term Thinking. Thanks for joining us. I'm Malcolm Borthwick, Managing Editor of Intellectual Capital at Baillie Gifford. There are lots of reasons not to invest in Europe. Its economic growth is uninspiring, and much of its stock index is made up of bureaucratic corporate dinosaurs. Also, Europe lacks the disruptive tech and social media companies found in the US and China, such as Apple, Facebook and Tencent. So what's the attraction? To find out, I'm joined in our Edinburgh studio by Paice, Joint Manager of the European Fund. But before we start the conversation, some important information. Please remember that as with all investments, your capital is at risk and past performance is not a guide to future returns. Stephen, why invest in Europe?
Well, firstly, thank you very much for that lovely positive introduction to Europe. Hopefully we haven't scared everybody off, but I think it's a pertinent point that the sentiment just now in Europe is just so negative. It's as negative as I've seen it for almost a decade. I was at a conference at the start. There was an online poll or an electronic poll, and the announcer or presenter asked all the delegates in the audience which region would they most like to allocate more money to or assets to over the next 6 months. And when the poll result came in, Europe was at the very bottom. So it had the least amount of people that were looking at that region to invest more of their capital. And I think that stems from a number of reasons. We're just bombarded with negative headlines in the press, the FT, the newspapers, the general press and media. I think people are worried about GDP slowing, as I think the numbers are now showing. Obviously, the impact of Brexit. We have the Mr. Trump, causing some issues with trade wars. And for mainly those kind of top-down macroeconomic and geopolitical reasons, a lot of investors are still sitting in the sidelines. But if you're maybe presenting it as a contrarian idea as such, it is the reason why Europe presents such an opportunity. And when we look at Europe, we look at it at a very different way. We look at it from the bottom up. So we're identifying and focusing on the individual companies first, and we're not paying so much attention to the macroeconomics, which we know mostly doesn't really have that much to do with stock market returns.
And as an investor, is it difficult to block out that noise, that negative sentiment?
It is. Perhaps one of the benefits of being based in Edinburgh is that we're not so much in that bubble that exists around London and some of the other financial centres around the world. It's part of our culture. It's part of the way Baillie Gifford operates. We have been bottom-up long-term investors for over 100 years now. And it just comes through practice. We're now much better at avoiding and ignoring a lot of the noise. We rarely pick our phones up these days. I mean, it's much more like a library, as you know, in the office. And I think that comes through repetition. So the more time we spend looking at individual companies, the more time we spend looking back through history, trying to identify what works and what doesn't, we kind of realise that the way to generate long-term sustainable returns is not to try and second-guess the market or what's happening in the economy or what the outcome of the next election is going to be. It's focusing on those big winners. It's focusing on those special companies run by entrepreneurs, people that we trust, that have kind of greater than average chance of generating outstanding returns. And that's what you have to do to provide your clients with good value.
It's interesting you talk about looking back through history, because you have done some research into what's made some of the most successful companies in Europe successful, haven't you?
Yes. So again, when we were looking back, I think we now know that most of the returns in stock markets and portfolios are generated by a relatively small number of companies. So what we wanted to do was focus on the European market and compare that to some of the other regions that create a lot more excitement and optimism, particularly in the US and China and so on. So what we did was we looked at the European market over the last 30 years. And what we wanted to identify were all of the companies within that period, within each discrete 10-year block, that appreciated more than 10 times, and this is where the kind of the phrase tenbaggers comes from.
What does that mean, tenbaggers?
Well, I mean, I think it actually originally came from baseball. So a four-bagger was used to describe the home run. So in effect, this would be 2 home runs and a double, it was described as. So a tenbagger effectively means that in the stock market parlance, that the company's share price will appreciate more than tenfold. So if you invest £100 over a 10-year period, if it was a tenbagger, obviously you'd get £1,000. And that's what we want to identify. I mean, these will be a relatively small subset of the European market, but when we looked at the number, for instance, of companies that appreciated more than tenfold, or these tenbaggers, the probabilities of finding one of these, let's say, tenbaggers in Europe is pretty much the same as it is in the other markets I mentioned, like the US and China. So this gives you some confidence. It gives certainly us some confidence that Europe still offers those kind of long-term bottom-up stock pickers a fabulous place to find and invest money. And I think that one of the interesting points that came out of looking at these kind of big winners in these different markets was that while the probabilities were the same, the opportunity sets were different. So in Europe, for instance, we don't have a tech sector as developed and as big as the one that exists in the US, which is driving a lot of the stock performance there with companies like Facebook, Amazon, Apple, etc. In Europe, we've got a slightly different mix of companies. And what we found was that the types of businesses that do well or have done well in Europe are typically less glamorous. I think that's probably a good way to describe them. These will be your classic Mittelstand companies in Germany, but typically niche.
And that's your small, medium-sized German businesses.
These are kind of small, medium-sized, niche B2B or business-to-business type companies, which will operate in fairly niche markets or industries. They could be chemicals distributors, auto parts manufacturers, rubber compounders. I mean, there's lots and lots of these kind of small idiosyncratic companies that importantly tend to dominate markets. They will be extremely profitable. More often than not, they will have a founder or at least a family involved. So that gives them a different outlook. It allows them to invest with a much longer term horizon. So there was a lot of these kind of niche B2B industrial businesses, but there were also a lot of medtechs, business-to-business services, and consumer discretionary. The other thing Europe has done very well over a very long period of time is produce some fantastic brands. So this is the luxury brands like Gucci, which Kering now owns. It would be companies like Hermes, even Puma, Hugo Boss. I mean, Richemont, which owns Cartier, which is probably the best hard luxury brand in the world, I think. So these pockets of excellence still exist in Europe. And I think that's what, again, should hopefully persuade people or investors that want to look at Europe that while the opportunity set is different, we still have a great chance of making a lot of money.
Give me an example of one of those idiosyncratic companies where there are barriers of entry.
One of our, in fact, it's the largest holding we have is a Dutch specialty chemicals distributor called IMCD. And this is a company where the risk of technological obsolescence is pretty low. And it effectively acts as a consultant. So it's connecting chemicals suppliers to hundreds and if not thousands of chemicals customers. And it's kind of the middleman economics. So it's a network type business. It outsources the distribution and logistics and warehousing. So it's actually fairly capital light. But the attraction here is that it operates in a really unglamorous, unsexy industry. This is the one I visited in Rotterdam recently. And even though it operates in this fairly niche market, it's by far the largest. So even though it's the largest, it only has perhaps 3 or 4% of the global specialty chemicals distribution market. So there's a huge kind of room and scope for it to continue growing. And it's also the natural acquirer and consolidator of that market. So the founder who still runs the business today, he set it up almost 20 years ago and works out of this really small head office in Rotterdam. And I think there's probably 6 or 7 people there. It's pretty small, but they're nimble, they're quick. And as they operate in a type family founder type business model, they attract other family founder type businesses who want to sell to them. So their strategy is to buy up all of these smaller distributors across the world and slot them into their network. And there's lots of these smaller businesses that from the outset don't look particularly attractive, but when you actually get into the types of things that we look for in terms of growth, competitive position and alignment, these are the businesses in Europe which stack up really well. And these are the ones that we're attracted to. It's not the large banks. It's not some of the larger energy companies. That's not our style of investing, and that's not where we think we're able to add much value or where any investors are likely to make outstanding returns.
And you mentioned earlier founder leaders. I mean, Europe has a very deep history of founder leaders in running its businesses, doesn't it?
Yes, and I mean, whether it's, you're looking at Scandinavia or, Europe in general, you tend to see a lot of very kind of traditional companies that are now run by multi-generational families. So in Sweden's a classic example, where you've got a number of families rather that effectively control holding companies, and those holding companies effectively control or have a great influence on the boards of a lot of other companies that exist in those markets. And by having that kind of ownership and family oversight, you tend to see that these businesses are much more adaptable and are able to survive exogenous shocks, whether it's a recession or downturn, because these are the companies which, it's not just families, it will be a founder type business as well, that they're running their business, if it's a family, to pass on to the next generation in a better shape than they inherited it. And if it's a founder, it's your baby. You don't want anything to happen to it. So this is why they're probably less prone to take risks or undertake value destructive acquisitions at the top of the market, where that might be the case in a kind of a bureaucratic company where the chief exec is incentivized just to grow as big as he can, a kind of a typical empire builder. So I think when you look at alignment, Europe does kind of punch above its weight in terms of the composition of the market being run by families or founders. And I think that automatically, and again, this is backed up with a lot of academic evidence, this type of ownership tips the odds in your favour of outperforming. So this is why we put a lot of focus on these types of ownership models. And I think in the fund probably at the moment, by weight, it's probably about 80% of the investments that we've made will be in a company that is either run or owned or managed by a founder or some type of meaningful inside owner.
And how do you deal with generational transfer? Because there is a drop-off in the success of companies after, say, the second generation and then the third generation, isn't it?
Yeah, I mean, this is I think it's called the stupid son syndrome, or even in some countries it's clogs to clogs in 3 generations. And there is the risk that a company will be passed on. It's kind of classic nepotism where the founder will pass it on to son or daughter, and they may not be suitable for running a business. And that is something that you need to watch for. A lot of the multi-generational families, however, that we've seen will tend to take a back seat. So when the founder maybe retires or moves off the board, the family members tend to then go onto the supervisory board to protect the family interest, and they then bring in professionals to actually run the business. So that's how to mitigate some of the problems with that. However, there are examples where the founder, who's been very successful in his own or her own right, has then passed it on to the son, who's gone on to be even more successful. And I can think of examples like Kingspan. It's an Irish building construction materials company, which again the son took over and helped internationalise that business and has taken it from strength to strength. The underlying point is that you can't use any of these rules to guarantee success in anything. You have to look at each business on a case-by-case basis. You have to look at who's running it, whether they're suitable, whether the incentives are aligned with what we would like, and take it from there. But certainly when we look at Europe, again, there are hundreds of these businesses which are run in a very entrepreneurial and long-term manner.
That's a good place to leave our podcast. Thanks very much for joining us.
It's been a pleasure. Thanks.
And you can find our podcast, Short Briefings on Long-Term Thinking, on Apple Podcasts, Spotify, and on our website at baileygifford.com/podcasts. We hope you enjoy it, and please spread the word. And if you'd like to find out more about what we've discussed in this podcast, you can find Stephen's paper, The Hunt for Europe's Tenbaggers, in the Insight section of our website at baileygifford.com. And many thanks to Lord of the Isles for the music. Until next time.